Dr. Stephen Nash from FIIG Securities joins us to answer that and plenty more. Stephen, look, thanks for joining us this morning. I want to get to global bond yields in just a minute. I wanted to maybe get your reaction to some comments we're getting from RBA Assistant Governor Guy Debelle, speaking somewhere in Australia at the moment. We're just getting sort of some headlines through to it. Some interesting comments in regards to particularly the cash rate, but also the impact that that's having on bank funding costs. At the moment, he says the cash rate is a powerful tool in steering bank funding costs. Look, I mean, is it, and if it's so, to what degree? Because the banks are moving independent at the moment of the RBA, and they've made it very clear that there is a whole host of funding pressures that they need to take into account well above what the RBA is doing with the cash rate.
Yeah, look, I think the overriding influence on mortgage rates is the RBA cash rate at this stage still. I mean, we have the influences of funding costs. I think in the minutes this week, the RBA made reference to some of the banks increasing mortgage lending charges. But I think the point was also made that those rises will be quite minor and that they could continue to occur, but it's well within the tolerance of the RBA at this stage. They see these rises as being fairly minor in nature. So we're not talking about 4 or 5, 6 point rises. We're talking maybe 1, maybe 2 more at this stage. So I think the idea is that the RBA definitely still has the control on monetary policy. Yeah.
It's interesting, obviously, for quite some time now, one of the major talking points when talking about the cash rate setting is how much, I suppose, of an interest the RBA takes in what the banks are doing with setting their own variable mortgage rates. And one of the comments coming from Mr. Bell says that the board is watching those funding costs when setting policy. So it is taking note of what sort of pressure and where the pressure is that the banks are feeling. Look,
yeah, we've seen funding costs for banks rise dramatically from mid last year to early this year. They have moderated quite a bit. However, comparing the current levels to mid last year, they still are quite elevated. That would support further increases by the banks of mortgage rates. But again, at this stage, not a whole series of them, probably 1 or 2 at this stage.
He's quoted as saying that the bank funding costs have risen, I think it was about 140 to 155 basis points relative to the cash rate since mid-2007. But look, are we in a new reality where we can't go back to where funding costs were, pre-GFC? I mean, the world has changed, and do we need to now market against the pressures and where the, I suppose, sentiment is at the moment?
Well, I think that's a bit of an understatement, actually. It's a different planet in terms of bank funding. I mean, we really are way away from pre-GFC. I mean, major banks used to issue what they call subordinated debt at almost 20 over swap. Now, those levels are way out compared to that. Now, senior bank funding, we saw that NAB deal earlier in the year about 185. That sort of level is really unheard of. And the pressures on the banks in terms of global funding is still there. A lot of competition globally. Also, they face the problem with the basis swap, and that tends to increase their cost of funding overall. There is a limited amount that they can do in the domestic market, given that we have an equity obsession here. And so that they are still reliant on global funding. And when those global deals go off again, I imagine that comparisons will be made and domestic funding levels will rise a little bit.
What about globally? As you say, look, maybe a little bit of a skew towards equities in Australia traditionally. At the moment, at least in the US, we're seeing investors push back, if you like, into treasuries. We saw the 10-year notes increase, the yields down. I mean, is that people chasing the yield that we've seen build up over the last couple of weeks, or is it a little bit of a safe haven play?
A little bit of both, I expect. With yields over 2.25 in the US, you're looking historically, that still looks expensive. But having a look at that broad economic picture that Bernanke was talking about last night as well, the improvements are great. They're great to be seen, and the equity market has recognised those. But there's a long way to go. As Dudley pointed out earlier in the week, that we're still looking at sub-trend growth, and we're still looking at unemployment being unacceptably high. We've had changes in the participation rate, which have effectively reduced the unemployment rate, and adjusting for those, the situation still is fairly delicate in the US. Yeah.
I wanted to get your thoughts on a couple of opposing opinions at the moment, albeit with differing timeframes. Goldman Sachs coming out, and we were talking about a little bit earlier, saying that they see a rally in stocks continuing for the next few years, saying that any decline in the US economic growth story has already been priced into the market, and the prospects for returns in equities versus bonds, I quote, are as good as they've been in a generation. You sort of contrast that with PIMCO, who admittedly are more of a bond-weighted, I suppose, sort of money manager. Look, they're fearful. I mean, they think it's been overdone, the rally. They think it's been overdone, the growth in risk appetite. Your thoughts?
Look, I think you've got to take both of those comments with a grain of salt. Obviously, there's vested interests at play here, but looking at the official comments, I think Bernanke is being very careful here. He still recognises Europe as being a major risk to the economic picture, and that was also highlighted in the RBA minutes as well. So I think, and I probably side with the PIMCO view at this stage. We have had a massive rally in stocks. I mean, Bank of America has risen 100% since mid-December. Now, okay, there's been adjustments in outlooks, but 100% is 100%. So I think it's time to correct a little bit of this optimism we've seen in the market. And with bond yields above the cash rate here in Australia, there are some good opportunities for investors.
All right, look, Stephen, got to leave it there. Great to talk. Thanks a lot.